$1 million in super sounds like retirement security, but how much income can it actually provide? $40,000, $50,000, $60,000? The arithmetic is easy. The difficult part is deciding what each number means, how long the money may need to last, and what happens when markets refuse to cooperate. We will use a hypothetical Australian retiree with $1 million in super. These examples are general information only. They do not account for personal objectives, health, housing, tax components, family circumstances, or eligibility for government benefits. Figures are simplified, and future returns are unknown. At 4%, $1 million produces a first-year withdrawal of $40,000. That is about $3,333 a month. It is a withdrawal from the account, not a promise that investments will naturally pay exactly that amount as cash income. At 5%, the first-year amount is $50,000, or about $4,167 a month. The extra $10,000 may materially change the lifestyle. It also removes more capital, particularly when investment returns are weak. At 6%, the first-year withdrawal becomes $60,000 or $5,000 a month. That does not automatically mean failure, but the plan has less room for poor returns, higher inflation, unexpected costs, or a retirement lasting longer than assumed. An account-based pension generally requires a minimum annual payment based on age. That minimum is an administrative rule, not a government judgment, that the amount is sustainable for your lifestyle. The factor can increase as you get older, so always check the current rules with the Australian Taxation Office or your fund. A fixed $50,000 may look comfortable today, but inflation gradually reduces what it can buy. Increasing withdrawals with prices places more pressure on the balance than keeping the dollar amount fixed. A realistic projection should model spending in today's dollars and allow for inflation over a retirement that may last decades. Fees are another quiet variable. 1% of $1 million is $10,000 in the first year. That does not mean the cheapest option is automatically best, but every cost should have a clear purpose. MoneySmart's calculator can demonstrate how fees affect the life of an account-based pension. Retirement cash may come from interest, dividends, fund distributions, cash reserves, or selling investments. Focusing only on yield can distort the portfolio. A diversified total return approach considers both income and changes in value, while keeping enough defensive assets for near-term spending. Now imagine a simplified 20% market fall. $1 million becomes $800,000 before withdrawals. Taking $50,000 then removes 6.25% of the reduced balance. The portfolio begins its recovery with fewer assets. This is sequence of returns risk. Two retirees can experience the same average long-term return, but receive those returns in a different order. The retiree who faces large losses early may have the worse outcome because spending continues while asset prices are depressed. Averages alone do not capture that risk. A practical plan can hold near-term spending in cash or defensive assets, rebalance periodically, and allow some lifestyle spending to adjust after poor markets. These choices do not eliminate risk. They reduce the likelihood of being forced to sell growth assets at the worst possible time. Australian retirement income can combine super, possible age pension entitlements, personal savings, investments, and sometimes part-time work. Eligibility for the age pension depends on current income and assets tests and personal circumstances. Do not add a headline pension amount to the plan without checking eligibility. Payments from a tax super fund are commonly tax-free for people aged 60 or over, but not every benefit or fund is identical. Tax can also apply to income and assets outside super. Confirm the treatment of your own fund and circumstances rather than assuming every retirement dollar is tax-free. So what does $1 million in super pay? 4% gives $40,000, 5% gives 50,000, 6% gives 60,000. Each is mathematically correct. None tells you by itself whether the plan will last or support the life you want. Estimate essential and flexible spending, identify every income source, include fees and inflation, and test poor market conditions. Use MoneySmart's account-based pension calculator and retirement planner with current information. $1 million is a strong starting balance. The plan around it determines what it can actually do.